The adjuster was kind on the phone. That is what the homeowner remembered most. After the fire, when half the house was gone and the family was sleeping in a motel, the man from the insurance company sounded genuinely sorry. He walked the property. He took photos. He said he would take care of them. The estimate he produced was $41,000 below what 3 contractors said the rebuild would cost. He was not lying about being sorry. He was also being measured, that month, on a number. The number rewarded the gap. A claims adjuster has a strange job. They work for the insurer, but their decisions land on the policyholder. They decide what your loss is worth. In theory, a neutral evaluator who applies the policy fairly to the facts. In practice, an employee with performance reviews, productivity targets, and in many companies, bonuses tied to metrics. The question that decides how your claim goes is not just what is fair, it is what the adjuster's scorecard rewards and who controls that scorecard. Some of those metrics are reasonable. How fast claims close, how many an adjuster handles, customer satisfaction. But others, documented in litigation and regulatory exams, track something more pointed. Average payout per claim. Leakage, an industry term for money. The company believes it could have avoided paying. Severity, the average cost of claims settled. When an adjuster is measured on keeping these numbers down, the incentive is no longer neutral. Paying you less makes the adjuster's metrics look better. The scorecard and your settlement pull in opposite directions. The homeowner did not know any of this. He knew only that the offer felt low and the adjuster seemed nice. That combination is what makes the system effective. A hostile adjuster invites a fight. A warm one invites trust. The homeowner almost signed. His contractor stopped him, pointing at 3 line items the estimate had left out: the roof structure, the smoke remediation, the code upgrades the city would require. Each omission lowered the payout. Each, on the adjuster's scorecard, looked like efficiency. The clearest window into this machinery came from litigation in the late 1990s and 2000s. Internal materials from a major consulting firm, prepared for large insurers, were revealed in court. They described re-engineering claims handling to treat claims as a cost center to be managed. Make a low initial offer. If the claimant accepts, the company saves. If they fight, the company wears them down with delay. The math worked because most people accept the first offer, and the ones who fight are expensive, but few. The incentive does not have to be a cash bonus to work. It can be a ranking. Adjusters compared against each other on average severity. The ones with lower payouts rise. The ones who pay full value fall behind, get coached, get flagged. You do not need to tell an adjuster to lowball. You only need to measure them so that lowballing is the path to a good review. The pressure is structural. It needs no single dishonest person to produce a dishonest result. Regulators have seen this. State insurance departments run market conduct examinations, audits of how an insurer actually handles claims. Some have found patterns of systematic underpayment, improper denials, and delays that violated state law. Penalties followed. But a fine in millions against a company earning billions is a cost of doing business, not a deterrent. The exam documents the behavior. It rarely changes the incentive that produced it. The metrics get renamed, the targets stay. The scorecard survives the fine. The homeowner pushed back. He sent the 3 contractor bids in writing and documented every omitted line item. He asked the adjuster to put the basis for the lower estimate in writing too, which forced the adjuster off the phone and onto the record. The number moved. The revised estimate came back $29,000 higher. He still had to fight for the code upgrade coverage separately. Refusing the first offer, with documentation, recovered most of the gap. That is the part the system relies on you not doing. Not everyone has the contractor who catches the omissions or the time to fight. Elderly claimants, people in crisis, people who trust authority, people who just want the ordeal to end, are the ones who accept the first number. The design works best on the vulnerable, which is the uncomfortable core of it. The low offer a contractor would laugh at is signed by a grieving widow because no one is there to tell her the roofline item is missing. The gap between offered and owed becomes pure margin. There is a counterweight you can hire. A public adjuster works for you, not the insurer, and is paid a percentage of the settlement, which aligns their incentive with yours. They read the policy, build the estimate, and negotiate from the documentation. On large or disputed claims, the increase they recover often exceeds their fee. The insurer's adjuster is scored on paying you less. The public adjuster is scored on getting you more. For once, someone on your side of the table is measured the way you would want them to be. What to do on any significant claim. Never accept the first offer without independent estimates from your own contractors. Get every reason for a lower number in writing, because writing slows the process and creates a record. Read your policy for replacement cost versus actual cash value, and for code upgrade coverage. For large losses, consider a public adjuster or an attorney. And remember the structure. The pleasant voice on the phone may genuinely want to help you and still be measured on how little they pay. The adjuster who came to the burned house was not a villain. He was a man doing a job whose rules had been written above him by people he would never meet, who decided the gap between what is fair and what is paid would become a number on a chart with his name on it. He was sorry. He was also measured. Both were true at once, and that is the whole design. The kindest face the company sends you still stands on the company's side of a line. The scorecard tells you where the line is. If this one stayed with you, episode 46, the three-word strategy, delay, deny, defend, is the playbook the scorecard serves. It shows what happens to the claims that refuse to settle cheap. It is on this channel.